So here we go, rule breaker investing. So my aim is to go high energy, half an hour through this and have 20 minutes of questions. If I go a little long, Ian, feel free to give me the hook at any point. And I do really look forward to taking questions. That's always a highlight. Certainly the Motley Fool, having started kind of as forums on America Online, we love the interchange and back and forth of ideas, one writer or thinker to another. So that's what I'm sharing today. So let's get into it. So yeah, the Motley Fool's purpose today is to make the world smarter, happier, and richer. As Ian mentioned, we started 27 years ago. So the year is 1993. Today we have 470 employees, which is 468 more than probably Tom or I ever thought we would have. And yet just a fraction of employees compared to companies that came along after us, like Google, for example. So it's been amazing to watch the growth of the internet. We've certainly benefited. I know we all have. But we're still a pretty small company today, but with a big heart and a big mission. I love our purpose statement. So yeah, fool.com is our website, and I hope each of you has been there before, and if not, come visit. We've got a lot of stock picks. We've got a lot of thinking about how to retire early, about how to get started investing, and the Motley Fool is doing more and more things. We have some asset management aspects to our business today. We're helping people find a better credit card, find a better interest rate. So we've really kind of diversified and grown what we do. We also have our podcasts, and I host the one at the bottom right, Rule Breaker Investing, and I do that every week. I've done that every week for more than 5 years. I love doing my podcast, and maybe that's how some of you have heard of me before or from me. I'm there behind the mic every single week. So I love podcasting and what the internet makes possible. All right, so let's get started talking about boats. We're all investors going through life, and the question is, which boat do you want to be in? Now, this is a rowboat, and it reminds me that Jack Bogle, the dearly departed founder of Vanguard, said, a lot of us are victims of the rowboat syndrome, Jack said. That is, we're paddling forward through the river of time with our money and with our investing, but we're looking backwards because we're in a rowboat. And that's the reason a lot of people, I think, buy high and sell low. They're looking backward at what the market's already done. And when all of a sudden the market starts rising and they're not in it, they're like, oh my gosh, I should have been invested. Looking backwards, paddle, paddle, paddle. They see the market going up. So then they buy. And somewhere shortly after that, the market's going to probably give back some of those gains. And paddle, paddle, paddle. They're looking at it decline. And they're like, oh my gosh, I should never have gotten in when I got in. So sell. Paddle, paddle, paddle through the river of time. So this is, I think, what a lot of us are afflicted by. And for me as an investor, I try not to be in a rowboat, the rowboat syndrome, Jack Bogle. Now, there's another boat we could take, and that's a canoe. And this reminds me of summer camp in Raymond, Maine, where I went for several years to summer camp. Our parents sent us away for summers. And you know, it's good to be in a canoe because on the one hand, you're looking forward. And that's what we should be doing with our money and as investors. So that's certainly an improvement over the rowboat. But the problem, in my experience with a canoe, which I remember very well, I'm sure a lot of us can relate to this. I mean, it can be a beautiful morning and you can be paddling along and enjoying yourself and it's placid. The problem is you have to work awfully hard to go very far in a canoe. So for me, a canoe is a metaphor for trading. For every single time you're having to paddle, you have to do something to make it go. And a lot of people are working a lot harder, in my experience, than they need to as investors because they may not be in a rowboat, although so many are. They're in canoes. I much prefer the power of the wind. And for me, Ian, and everybody watching, the power of the wind is the compounding returns of the stock market, rising something like 9% annually for the better part of the last century. And I predict it'll be similar over the next century. That's the win. That's capitalism working. That's entrepreneurs coming up with better ideas and replacing older technologies with new solutions. And people who have created possibilities that you and I couldn't have dreamt of as little kids. That's going to keep happening over the next century. And the stock market reflects the growth of human ingenuity, human productivity. If you zoom in on any 2-year period, it might be ugly. But if you're actually in a sailboat, letting the wind of capitalism and the markets just power you, you have a lot more fun. You've got a drink in your hand and you go a lot farther. So I'm all about the long-term. I don't use the phrase long-term investor. I believe that's a tautology. Investing is by definition long-term. And I think that's the way you and I should be investing. That's the way we should be playing the game. Otherwise, we're trading. And trading to me is in a sense, the opposite in this way of investing. So which boat do you want to be on? I know which boat I want to be on, and the one I've been on for a while. And Ian, you mentioned Motley Fool Stock Advisor. So we started that in March 2002. I picked one stock every month ever since, through good markets and bad. Yep, coming out of the horrendous wreckage of 2001 and then entering the great financial recession of 2008, 9, and then the last 10 years, and 35 percentage point down in March and back up and all the way through. If you just kept buying each of the picks with the equivalent of a $10,000 investment at the start, you would have done very well. And the power of the Motley Fool Stock Advisor is it's the same day every month, generally a new stock, although sometimes a re-recommendation. It's mechanical, and we're trying to make it easy, just like that sailboat for our members. So what I'm sharing with you today is how I've achieved these returns. And it's at the heart of it, it's something that I call rule breaker investing. That's the name of my podcast. That's the book, Rule Breakers, Rule Makers, that my brother Tom and I wrote in 1998. So I'm still basically doing the same thing I was doing 22 years later. Maybe some of you read that book. If so, get ready for a quick summary of what I said 22 years ago that I'm still using today. And let's get started. 6 signs of a rule breaker. So these are traits we're looking for in the stocks that we pick. The first one is top dog and first mover in an important emerging industry. And if I had only one trait that I had to pick and I couldn't use any of the others, I would use this one. Because these are the great world shapers, the world builders, the companies that you want to own. You want to be able to tell your grandchildren, Granddaddy, Grandma, did you own Amazon in the 1990s and 2000s and 2010s? You want to be able to say, yes. Yes, I did. And did you own Netflix as the world went to streaming? Yes. Yes, you did. And how did you get into these companies? The answer is bravely, because many times it does take courage. You bought the top dog and the first mover in an important emerging industry. So if you took the entire stock market and just got it down to that group of companies and fished in that pond, you would be a very rich fisherman. Top dog and first mover in important emerging industry. Second is just a sustainable advantage, because after all, if you're going to buy stocks and we buy them for a minimum of 3 years, preferably 3 decades, if you're going to buy stocks with that time frame, the only time frame that matters to me, then you want to have a competitive advantage. It needs to be in place. It needs to be that moat that Warren Buffett and many others have made famous over the years by helping us think about competitive advantage. It takes many different forms and shapes, and sometimes it's subtle and sometimes it's not there, and a stock can still be a great stock or a great company. But it's really important to me as a rule breaker investor to find sustainable advantages. Often it's just the visionary leadership. It's that this company had Jeff Bezos, that one didn't. That's one of the most sustainable advantages, especially if they're founders with a lot of stock, that I can imagine. The third is where we start getting into stock dynamics, because strong past price appreciation is a very important aspect of rule breaker investing. And it's what starts to lose some people. Some people start hopping off the bandwagon at this point when they think about this notion that we want stocks to have done well before we ever pick them. We want to be able to look backwards and see this stock has outperformed. Now, if you're familiar with William O'Neill and Investors Business Daily, or you're familiar with momentum investing, and I know while you probably don't practice it, I'm sure all of us hearing me today have heard the phrase and might practice it. I don't believe it's worth pursuing on its own. I don't like algorithmic, purely momentum-based investing, but I like to thread that as one of the attributes that I'm looking for in rule breakers, because after all, if we do think we found the next Amazon or Netflix, chances are the stock's going like that, and it's going to keep going like that for a long time. It's not going to go like that, or you're trying to make excuses for 3 bad quarters or the technology's not working. Those companies usually don't end up being the world shapers. And so strong past price appreciation, the reason I'm showing Isaac Newton, remembering my schoolboy science, Newton's first law of motion, objects at rest tend to stay at rest. Objects in motion tend to continue in that motion in a straight line. That is my experience of life. I believe that's a very important thing, not just for investing or finding winning stocks that tend to keep on winning, but of course, winners win, which is one of my favorite hashtags and a phrase I overuse a lot. I think is true of so many aspects in life. A lot of the winners that I knew as kids are winners today, and I would have invested in them if I could have when they were my high school class president or gotten a piece of them as they did this or that interesting creative pursuit in college, but I couldn't because I couldn't buy stock in them, but I can buy stock in companies that keep rising, that keep going. And unless there are significant forces exerted from outside of that to change that, that's the paradigm that I assume will continue being the case. I might have a chance to talk a little bit about that later. Strong past price appreciation. Okay, next one. Obviously, it's the people for me. It's not the product or the service. The competitive industry will change. The dynamics of these companies and where they're competing will always be dynamic, but the people at the heart of the companies, that's who we're investing in. They're the ones making the calls on what to do next and where to take that enterprise. And of course, as I mentioned earlier, if they own a lot of stock, it makes me even more confident as an investor to have them. A quick word about smart backing. You know, this is really important for me as an investor. Who's the company or the entity funding that company? I believe that the character of those people and their past performance is very telling. By the way, a quick pause, because I know I'm speaking at the MicroCap Summit. Of these traits, the one that I think is most worthy of focusing on is that first one. So it can be true that microcap stocks can exert top dog and first mover status, but very often, especially these days, that's not the case because these companies stay private for long periods of time and then come out at much higher valuations. Sometimes I'm still interested in buying their stock, or sometimes they've gotten so big that I'm no longer interested. I do appreciate looking for smaller companies, but the one thing we have to guard against as microcap or smaller cap investors is making sure that we're buying the real winners of our time and not just finding some small niche company that from a small place has a good short-term outlook, but is this really going to be a company that grows and helps shape our world over the next 10 to 20 years? That's where I try to stay focused with my rule breakers. All right, so number 5, brands. And there's a pretty good example of one. And not every company is a B2C, but for me, I love to find the companies that have the brands. What is a brand? It's a promise that you make and have to fulfill on every day. So the company that we're looking at right there, I think has done that very admirably over more than 30 years. That's one great example, but there's so many others. I would say, what is the greatest brand in the world today? Not coincidentally, I'll say it's the company with the largest market cap, unless things have changed this morning, Apple. So I think it's really instructive to remember that the largest, most successful company of our lifetimes, Apple, is also the largest, best known brand, and in many cases, best loved brand in the world. So these are all really important attributes. So I'm giving you my 5 traits of the rule breaker stocks that we're picking. But what is number 6? This is kind of the secret sauce. I need everybody to think that this stock is overvalued. Again, that may seem very unusual. Why would you be looking for stocks that everybody that on the front page of Barron's, they're saying is dramatically overvalued or is just generally regarded as overvalued? Well, just to summarize, if you found traits number 1 through 5, the top dog and first mover in an important emerging industry, and number 2, it has a competitive advantage that is of note to you, and number 3, that this company has strong past price appreciation, number 4, good management, smart backing, and number 5, strong consumer appeal, and then somebody who looks something like this guy is telling you that that stock is overvalued, that is a great sign because it means a lot of people are not in the stock. They think it's crazy overvalued. They would never buy it where it is today, but you've got all the key elements in place for some of the best stocks that you and I can find over the course of any given era. So it's in fact this key dynamic that helps rule breaker investing, because a lot of people are like, I wouldn't buy that. I wouldn't buy Amazon. How many people said that? That company will never make money. How many years did they say that for? And so this is, again, great stocks climb a wall of worry. What happens is nobody believes in Amazon at the beginning, and then somebody believes in Amazon and buys the stock, and then 3 more people then believe in Amazon. They buy the stock, and over the course of 30 years, you end up with just spectacular gains for companies that are true rule breakers, that exhibit these kinds of traits. So this is a short course. I'm trying to move fast this morning to get through a lot of material, but we just covered rule breaker investing and the 6 traits we're looking for in stocks. And what it has you doing, in effect, is overpaying constantly. But you're going to overpay for something that runs deep. and that is much, much bigger than it looks like at the start and has many greater possibilities. And so here are some of the examples from my own investment lifetime, stocks that I picked that are all active recommendations still today in Motley Fool Stock Advisor and Motley Fool Rule Breakers, the two services that I oversee. Each of these are the years we picked them. And as I mentioned, we hold them all. We've added to them typically over the course of time. We'll be talking about that on the back half of my presentation. They're from different industries, but they exhibit the tendencies that I've shared with you this morning. So that's my brag page, Ian. There we go. I'm bragging. Those are some of the best stocks that we've picked, and really some of the best stocks that have been on the market. And I think, again, to emphasize, these are all active recommendations today. I like each of these companies over the next 10 years. So when they double again, these numbers will look even sweeter. And the only way you can get these numbers, by the way, is to hold over long periods of time. It's not a lot of work. It's a lot more work in a canoe to be trading in and out. For me, I'm sitting in the sailboat letting these companies do their thing, having identified, I think, the right attributes that we're looking for as investors to buy and to hold. So those are some of my favorite examples. Let's next move on to some new stock picks, because I figure as long as I'm here with you this morning, you probably would like to hear some of the stocks I'm recommending right now. And so here they are. These are for Motley Fool Stock Advisor and Motley Fool Rule Breakers. The most recent month that was, these are the 5 best buys now. These are existing picks within our services. So I picked these in some cases long ago. For example, that Disney was actually Marvel that we bought and held. We bought and held ever since Tobey Maguire was Spider-Man, and then Disney bought out Marvel. We just transferred our shares over, and here I am re-recommending Disney today. But each of these are stocks that I like over the next 3+ years from today. That's why they're our best buys now. Sometimes people get confused, and maybe it's our fault with the language, but it doesn't, when I say now, it doesn't mean I expect them to go up next week. It means that if I had new money to deploy thinking 3+ years forward, those are 10 companies. That's not a bad 10 stock portfolio. I bet that'll beat the market over the next 3+ years. So free stock picks for the morning, and let's keep moving. So one of my favorite words I invented. In fact, we have screen names on the Motley Fool forums, and my screen name is TMF Spiffy Pop. So if you ever see a posting on our forums at fool.com from TMF Spiffy Pop, that's me. And if you didn't come in knowing this morning what a Spiffy Pop is, I want to make sure you don't leave this morning without knowing what a Spiffy Pop is. So a lot of people are excited to hear their stock popped. Like earnings come out, the stock's up 22% the next after hours, and maybe that translates through to actual trading the next day. And they're excited about that pop. But I get more excited about a special kind of pop that I decided should be a thing. So we gave it a name to make it a thing years ago. It's a Spiffy Pop. And as you can see, it's when you make more money in a single day than your cost basis, than you originally paid for that stock. So in the example given, if a stock whose cost basis is $23.25 for you comes out with great earnings, and the next day, maybe it was at 100 and it goes to 127. It's up $27 a share. That is a Spiffy Pop. And those are the pops that I think we should be shooting for. And the more you can rack up over the course of your investment lifetime, the better. These are the Spiffy Pops that we've had so far in the services that we have at the Motley Fool. There have been a lot in 2020 because of the crazy market, but they've been going on for years and years. And these are stocks that, by the way, I stopped counting. That final column you'll see for each of these is the number of times it's happened. But we stopped counting once we've hit 13. So if you look at Tesla in that middle panel, you'll see that it had its 9th or 11th, depending on who picked it, me or my brother Tom. We both have liked Tesla. We'll stop counting at 13 because it's boring at that point. You have a stock like Netflix is Spiffy Pop so many times. If it just goes up or down 1%, it does a Spiffy Pop these days. That's just empty chest pounding. So after you've had your baker's dozen Spiffy Pop, you stop counting. We've had a lot of them at the Motley Fool. We're going to have a lot more because we're just doing exactly what I've been sharing with you this morning, finding the great companies and holding them. We try to get in, by the way, before most other people, but we're never going to be first. We try to get out way, way after almost anybody else. And that's how to invest as a rule breaker. Now, speaking of investing as a rule breaker, this is just a quick summary slide of what we've already covered. And this is In my first half of my presentation, time check, 10:19. Okay, my first 2/3 of my presentation, we covered the traits of the companies that we're looking for. And here we are. These are what I've been looking for in stocks for a few decades now. The back third of my presentation, I'm going to talk about the 6 tactics of the rule breaker investor. Basically, the traits that you should exhibit in your own investing, because it's one thing to give a stock like Amazon or Mercado Libre to an investor. How he or she proceeds with that stock leads to radically different outcomes. You can give the same 10 stock portfolio to 2 investors at the start of the horse race, and they can be at completely different places near the end of that horse race based on what they're doing. And so I realized a few years ago we should have not just the 6 signs of rule breaker stocks, we should have the 6 traits or tactics of the rule breaker investor. So let's go over those. Those are a little quicker to go through. So the first one is rule number 1, let your winners run high. And the reason this is rule number 1 is because I think this is as important, more important than any of the others. Because again, it's one thing to have Amazon, Netflix, or Mercado Libre, but if you just sold it to get your 20% gain and jump out, or if you sold half because you're now playing with the house's money after it's doubled, one of the silly phrases made popular by Jim Cramer and others over the course of our lifetimes, then you're really not going to do nearly so well as you should have if you just obeyed rule number 1, let your winners run high. And I want to point out with these 6 tactics that I'm sharing with you that I put a mnemonic in each of them. So for each of the 6, I've tried to lace the number of it right in there. That's why I've emphasized 1. Actually, it was Allison Southwick, my very talented PowerPoint creator, who emphasized 1. I didn't do this work. So that's to help you remember that that's rule number 1. So let's go to rule number, well, actually, yeah, it leads to this, right? That's what happens when you let your winners run. And because I don't want to belabor 3 companies, we've had a lot of other winners. Here are 3 others that we've done the same thing with. And these are the years that I've recommended the stocks. Tesla 2011, a 9-year hold. Shopify 2016, February. NVIDIA 2005. Again, very, very low cost bases. Every one of these stocks I continue to actively recommend today. These are great companies here in 2020. And even if some of them are crazy overvalued and or temporarily overvalued, maybe Tesla will be cut in half over the next 6 months. Those of us with a cost basis of $6.29 can take getting cut in half a lot better than those who are only just discovering or not even investing in Tesla at all. So again, following the traits that I shared, but then exhibiting the tactics of the rule breaker investor is what gets you these returns. Let's go to tactic number 2. Add up, don't double down. Yeah, I think I've already been pointing out, not only do winners win, but you as an investor, if you have extra money left over and you want to not initiate a new position, but add to an existing position, I about 98.5% of the time add to things that are winning for me. So I was taught not to throw good money after bad. That was my dad who taught me and my brother Tom investing. And we've always obeyed that. We've always behaved that way. And it's counterintuitive for most people. Most people, right? They're, as the old phrase goes, they're watering the weeds. And they're clipping their flowers. They're portfolio rebalancing. They're selling off their good ones to add to their bad ones. And that is not going to work very well for rule breaker stocks in particular. Again, these 6 traits I'm giving you, these tactics, I'm not saying that you should always do these or that these work in every case. I'm saying as a rule breaker investor, these are the tactics you should exhibit. I realize some people really love the concept of buying low and selling high. I think it is 4 of the most harmful words in the English language. I inveigh against them regularly on my podcast. I'm looking to buy high and never to sell. I will not go into my mini rant because time will end up getting short if I do, but I hope the message is clear. Let's go to number 3. Invest for at least 3 years. I've already said that once or twice this morning in my presentation. Ian and team here, yeah, at a minimum, we're thinking 3 years. So I just, when I buy, which I do regularly, mechanically, I just don't even think about it for 3 years. I spend very little time paying too much attention to those stocks unless they start winning 6 months later, at which point I might start to add to them. If they're losing, I usually think, since I lose a lot, that's part of being a rule breaker investor. You have to have a lot of losers. You're kind of taking the VC mentality. You're willing to put in a lot of different bets and then let the ones that win so well that they wipe out all of your losers and still leave money, a lot of it, on the table. So it's that mentality of being in it for at least 3 years. You know, the word invest comes from Latin investere, to put on the clothes of, to wear the clothes of. It's the same. The word vestment, priestly vestments, the same thing. You're putting on the clothes. That's the mental image that I think a lot of us should have when we think about investing in companies. You should love the companies you invest in, just like you put on the sports fan jersey as you go to the stadium. Once we all get back to stadiums in the year and years ahead, a lot of people like to wear their home team jersey, even just to the bar on NFL Sundays. Exactly the same how I think about my portfolio. I want to love my companies, and I'm going to be wearing the jersey whether we win or lose this Sunday, this quarter, this year. This is really important. What does the word invest really mean? That's what it really means. And I'm just trying to get as many people worldwide to understand the etymology of this word as possible, and then behave accordingly. So yeah, I happen to be a University of North Carolina alumnus. A lot of these lessons about winners win. I think North Carolina basketball in particular has exhibited a lot of what I'm looking for in a stock, right? Buy, excellence. You're overpaying. They're overrated. Boy, were the Tar Heels overrated last year in basketball. But you buy and you hold. And over time, let time pass. Dean Smith shows up. Roy Williams shows up. You have some down years too, but you win national championships repeatedly. You build a strong consumer brand. People want to be part of your program. All of those things that I see in sports are so true for the stock market with the approach that we're talking about this morning. Other people have different approaches that no doubt work for them too. I'm just giving you mine because Ian asked me to share. All right, numbers 4, 5, and 6. Let me see. It's 26 minutes past, so I think I can do these in about 4 minutes, Ian. Looking forward to taking questions, by the way, as always. So number 4, remember the 4 tenets of conscious capitalism. Now, some of you will already know conscious capitalism. Many of you will not. I'm on the national board, and John Mackey, the founder of Whole Foods, is sort of the founder of the movement. And I've drunk the Kool-Aid for this one for a long time. And I'm not going to give you a short course on conscious capitalism, but I think it's very important to recognize. I think it's great to practice in our businesses. I think we all should be conscious capitalists. If you're not already, read more about it, Google it. You'll find a little bit more about it online. You might say, hey, I just realized I am a conscious capitalist. I didn't know what that was, but this is how I behave. I would say, great, welcome to the movement. As investors, boy, do I look for these attributes in the stocks I'm picking and the companies I'm going to be a part owner of, with hundreds of thousands of our subscribers who are following right along with what Tom and I are picking, and the rest of our advisors, right? We're all owners together over long periods of time. So I find it very helpful to know the 4 tenets, tactic number 4, the 4 tenets of conscious capitalism. Number 5. Yeah, I don't think anybody should ever enter a new position with more than 5% of their portfolio. So max 5% allocation. We can give great stock picks to people, but if they load up on one and then turns out it wasn't a great pick, it's one of the many losers that I picked over the course of time, they'll lose and often conclude that this doesn't work. Rule breaker investing or the stock market period is not for them. And isn't that sad to think about the sailboat they could have ridden their whole life long, but they didn't actually allocate in a way that will allow them to be able to lose and enjoy the great fruits of winning. So what's the minimum number of stocks in a portfolio? Well, do the math with me. 20 as you build a portfolio, but frankly, I like a lot more than that. I'm not really a focused portfolio investor. I've found that you can beat the heck out of the market with a lot of stocks. And if you saw my numbers from Stock Advisor that I led off with earlier, that was one stock pick, let me see, every 12 months. So that's 12 a year. And here we are 18 years later. So you can do the math and see that it's a couple hundred picks. And those combined together have crushed the market. So I don't think you need to have just 22 stocks or only 8 stocks. I think the more the merrier. And it also means for a lot of our members who follow our advice, they don't stress about any one company. They're not that worried about any one year or earnings report. So what's the right number of stocks in portfolio? Well, there you go. The answer is there is no magic number. I just think max 5% allocation for new positions. And then finally, aim for 60% accuracy. That's the 6 in tactic number 6, 60% accuracy. So accuracy is a phrase that I use to describe beating the market or not. So when you pick a stock and you beat the market, I would say in baseball terms, I'm a baseball fan, you got on base. That's a 1 for 1. So we're going to try to get on base 6 times out of 10. We're going to try to beat the market 6 times out of 10, which, by the way, is not that easy to do because market studies will show you that not even 50% of stocks beat the market over meaningful periods of time. Because the biggest winners carry the whole market, it's actually a minority of stocks, if you look at the statistical distributions, that beat the market. So if you're aiming for 60% accuracy, you are definitely aiming high. You're probably getting higher than I do. In my services, I'm probably closer to 50%. But again, with all that I shared with you this morning, the 6 traits I'm looking for in stocks, the 6 tactics that we're taking as investors, you follow those and your winners so outweigh your many losers that you don't really worry too much. And so that accuracy number is good to shoot for, but a big win cancels out 99 losses in my experience. And it's actually all been numerically proved through our website and the transparent scorecards that we've managed for 20 plus years in front of investors. So, and Motley Fool Caps, by the way, if you hadn't seen that before, is a great way to get better and to test that out. So here they are in summary, Ian, and let's get to some Q&A here. It's 10:30 sharp. The 6 tactics for the rule breaker investor. Thanks for suffering full gladly. And I will mention, Ian, you are muted. So if you are saying
I am muted. I am definitely muted. Okay. Thank you, David, for that amazing presentation. Let me end your screen share, or you can if you can.
Thank you, sir.
So I just want to remind people, if you had questions, feel free to populate the Q&A button down at the bottom of your Zoom screen. Feel free to ask your questions there. I'll start off with a couple. And one of the things I love about your rule breaker method is it really does break a lot of rules. And I loved how I think it was 5 minutes ago, you were talking about, everybody thinks that when it comes, you need to have 10 positions, you need to have 20. Well, that's wrong. You need to be 8, you need to be 100. And I think history has taught us that there's a lot of skilled investors that invest differently, and that's why they're successful. They don't invest the same as everybody else. And I appreciate the ways that you're different, and it definitely works for you, works for your mentality, your emotional, it connects with who you are.
Thank you, Ian.
And so maybe to that end, one of the questions that always pops up is what, and I'm winding you up with this one, but what is your sell discipline? That's and maybe you can relate that into, the FANG score a little bit.
Thank you. I really appreciate those phrases because you and I know that those phrases mean a lot to me. I'm sure a lot of people are seeing me for the first time this morning or haven't come across me before. So they don't know that you've triggered me twice in a wonderful, wonderful way. So let me first talk about sell discipline. So I think the joke is, and the trigger there for me is, why don't people ever talk about buy discipline? And I also love that it's all such a discipline about selling. Like it makes it sound like such an important thing. You'd be irresponsible if you don't have a good sell discipline. But at least in my experience, Ian and everybody, what you buy matters a lot more than your sell discipline. It's one thing to, be a buy to hold investor, which is what I am. But if you don't have good companies, you're not going to feel great about buying to hold. You're going to start thinking you need to trade because you have, in my experience, not the right set of companies to be investing in. So I truly believe the discipline of knowing what to buy is much more important than the sell discipline. But let's talk about selling because I think underneath that question, then we'll get to FANG score in a sec. Underneath that question is, how do I approach selling? And the answer is I don't spend a lot of time thinking about it. I don't do it very often. And as a consequence, I have a lot of losers just sitting in my own portfolio or in our services. But because add up, don't double down is part of my tactic, the good news is losers lose meaning over the course of time, right? Because as something gets cut in half, and I've had a lot of those, its allocation to my portfolio is small. And winners take over. They just make bad picks just noise and not even, I would say, decreasing amounts of noise over the course of time. So When do we sell? Well, one of the most frequent times we sell is when we get bought out, when one of our companies gets purchased by somebody else, and it's an all-cash deal, we'll sell. Certainly, if a company goes against what I consider ethical behavior or strongly against the thesis that I had in the first place, it isn't to say that it doesn't follow my thesis. I don't expect anything to follow my thesis. I'm not that smart, and the world isn't going to conspire to do what I want it to do. I'm very open to having my thesis broken. But if it's broken in a horrific way, I'll sell. It usually means, by the way, Ian, I'm the last one out so often. Like, I'm never going to be with William O'Neill, stock drops 7% and we're out. Like, that is so antithetical to what I believe works on the markets. And I respect William O'Neill a lot. But anyway, so that's a little bit of a meditation on sell discipline. FANG score. This is a phrase that I guess I've half created. I didn't create FANG. I don't know. Was it Kramer? I don't know who did this, but I've always found it really silly to take a few stocks and create an acronym and then say FANG stocks. And half the time people are saying FANG stocks, they don't know what the letters stand for, and they're using it to apply to stocks that weren't intended with that initial group of stocks. What I've said is, rather than think about, do you own Facebook, Amazon, if you will, Apple, I guess, Netflix, I think, Google, but that's Alphabet. But, and by the way, what about Shopify? What about Mercado Libre? What about stocks that are amazing and aren't included in this silly acronym that has created this culture around in some senses? But what I've said is, rather than get carried away with what letters you have in your portfolio, how about how long have you owned those letters, or any group of letters that we want to start? People are like, FANMA is the new FANG, or whether there's always a new acronym. But Ian, I'm all about like the number of years we've held Facebook, Amazon, Apple, Netflix, and Google, and those are all active recommendations. And I think the minimum holding that I've had for any of them is 8 years, because I think we started Facebook in 2012. I've held all of the others longer than that. So I would say more important than FANG stocks is your FANG score. And your FANG score is you total up the number of years that you've owned the stocks in that group. And so that is the FANG score. And thanks for a really fun question, Ian. I appreciate that.
No, thank you. These rule breaker attributes that you look for and your methodologies on executing them as an investor, how would you say that has evolved over the last maybe 10 or 15 years? This is probably not a belief system you thought 20 years ago. Perhaps it was, or you were just putting it together. But how has it? What are the little areas and the edges that you've kind of fine-tuned it maybe over the last 15 years?
Yeah. So the 6 traits that I led off with are the exact 6 traits in the book 22 years ago.
Oh, it was 22.
And I think there's
okay.
a strength to that. I want people to know that, because I definitely believe in constant improvement and tweaking, but I also think, especially in this herky-jerky world we're living in, that the things that endure are important. So this is not a strategy that was tweaked 4 years ago to be able to backdate it and have better performance. This is not something that became a fad post the GFC. This is literally what I wrote 22 years ago and have been doing for years before that and all the years since, and I expect to continue to do that, right? But if that sounds like I'm a stick in the mud kind of guy, please know that I have lots of additional thoughts about what works in investing. For example, the tactics that I shared as the back portion of my presentation today, those I came up with a few years ago, right? Because I started to realize it's one thing to give those 6 traits and follow them as we have, but you really have to train investors about how to use this toolbox that you're giving them. If they're using a screwdriver to try to pound something in, or if they're damaging themselves with a power saw, then it's not enough just to have a list of traits that we're looking for in stocks. We really have to think about you and me, the investor, our mindset, and what we're doing. Certainly, our good mutual friend Morgan Housel has done great work, both on the Motley Fool site over the years and in many other places. And his book this fall is the most recent example. But the importance of mindset has not been lost on some of the better minds of our generation. So that was an addition. That's an enhancement. Like if I write an update at some point, I'll then include that.
Oh, thank you. Thank you. That's enough of my softball questions for you.
That I'd like to share. I won't now because we don't have time.
Let's go to the audience. Go ahead, Mike.
So the first question is what stage do you start investing in a company? Is there certain criteria, especially when you kind of tie this into micro caps? You can have a company that says we're going after this, $50 billion market and we're going to win the whole market, and our solutions, the, you know, the best right now. But a lot of us know that you know it's easy to say, it's much harder to execute on. So how do you think about that in your process?
Well, that's a great question, Mike. I think that part of the reason I'm not that focused on microcaps, I mean, there's a couple of reasons. One is functionally, I couldn't really recommend them at Fool.com because the stocks would bounce too high right now, I think, if we're really talking micro caps. Because as we pick new stocks for Rule Breakers, the stock advisor, they're already popping at the market. And so it just wouldn't work. And that's good news, I think, for some microcap investors, because we can't start that early. But I would also say that you don't have to start that early. I think the dream is to find companies at their very start. But if you really want to have that dream, become a venture capitalist, because that's the business of venture capital. And I know some of our participants this morning, that's exactly what they're doing. And we're also doing that at the Motley Fool. We have Motley Fool Ventures these days where we're investing in those companies. But Mike and the question asker, I would say if you're right about that microcap seriously having a run at that $50 billion market, you'll have time to discover that. You don't actually have to own that from its microcap status. If you do or want to, more power to you. But for me, part of that strong past price appreciation is actually a risk mitigation trait, because it means that the market is validating that that company is for real. It is doing real stuff in the world, and the market is recognizing it and pushing the stock up. So you're not going to, that Netflix, our Netflix cost basis, Netflix was, I think, a $1.2 billion company. So it's been a 200 bagger. It's right about 200 times since then. So it's somewhere now around 200 and whatever, 20 or $30 billion. I don't think Netflix was thought of as a micro cap back then. Now looking backwards, more than 15 years, we can say, yeah, it was just about a $1 billion market cap. That's about a minimum market cap for me as an investor. So I hope those provide some answers to those questions, that question.
Yeah, it does. In fact, I'd kind of just add one of the things that we find in the microcap space is that often companies that want to go after these big areas, what they really have to do to succeed is go after a niche first and then add other niches to that as they develop, because the ones that kind of try to go after the whole enchilada at first usually end out getting indigestion.
That's fair. And, I think about a company like Shopify, which is a good example more recently, right? Because it came public about 5 years ago. And I don't think it was ever a micro cap. I mean, I should say it's a public company. Maybe it was, but Toby Lukey and what he was doing with Shopify, actually, it all depends, Ian, on how we define microcap, but maybe it is a microcap. What I'm trying to say is that often real rule breakers of the specialized subset that I invest in, that I've been talking about this morning, often they don't have a microcap valuation that you or I could participate in. We can look backwards and see that, wow, Amazon was a sub-billion-dollar company when it IPO'd. So we can say that that might have been a market cap back in that time, although I thought of microcap as more like 50 to 100 million market cap back then, and it was never at that. So I don't know that, we may miss some of the best companies if they come out as raging rule breakers like Shopify did and is, if we're just focused on the micro space.
How do you think of industries to invest in? Or, I assume that there's probably areas that you're attracted to and areas that you avoid.
Well, for me, I'm a go anywhere investor, and that's both geographically and it's also the business we're talking about, industry. So yeah, in no way am I focused on any niche. I do feel like I have a better read on internet companies because that's what we are. And so I feel like, having grown up on the net over 27 years as a co-founder, I feel like I have better pattern recognition there. Just like anybody else would say, after 27 years, I have better pattern recognition about this or that thing because I love jazz piano. And so I think I can hear jazz better. But I think it's really important for us to be able to go anywhere and not niche ourselves too much. I do deeply admire people with deep subject matter interest within a given sphere. I'm never that person. I'm a mile wide and an inch deep. But as a humanities person, as a generalist, I like to think I can go anywhere and learn anything. And last thing I want to say is that, yeah, for us as investors, I think the real thing to seek out is who's the innovator, right? Who is innovating in that market space, in that industry? That at the heart of it is what I'm trying to pick each time, is the innovator. And part of the beauty of this is a lot of people are skeptical about the innovators. How much skepticism has there been about Tesla, and still is today about Tesla, and yet in some ways still justified about Tesla. But this is just one example of a lightning rod stock, but that's just another rule breaker in my mind. It exhibits the same traits of so many other winners that I've had and losers that I've had too. Always happy to talk more about my losers, but I think it's really important to just identify that they were the innovators, right? Netflix and Tesla. They were the ones coming to market with a new approach that was disrupting, challenging the conventional wisdom with my full cap on, challenging conventional wisdom and breaking the rules. Those are the rule breakers.
So what industries going forward do you see as becoming mainstream, where you might find the next rule breakers?
Well, I mean, I think a lot of them already exist. So I don't spend a lot of time dreaming or hoping that brand new industries will happen overnight, because think about the internet itself. It has been around for 30 years just about now in popular culture, and it continues to provide incredibly great new upstart companies that didn't exist 5 or 10 years ago, and all of a sudden are world beaters 5 or 10 years later. So while I could start saying things like augmented reality, lots of robotics, things that Americans will probably take for granted 50 years from now, we'll look backward that we were talking about them in such awkward ways. So I don't spend a lot of time trying to predict what that will be. I just try to recognize it near about the time it starts to happen at scale, and then we get our money there. One of my favorite words from German, I never did take German, is Zeitgeist. It means the spirit of the age. We use it in English. So what is the spirit of the age? SaaS companies today are an obvious example of the spirit of the age. Internet back in the day, biotechnology. So I really believe your money should be demonstrating, like evocative of the spirit of the age. We shouldn't be off in some weird corner trying to make money in some strange way. We should own the companies that we've talked about over this hour. These are the zeitgeist. And Mike and the questioner, yeah, the zeitgeist will keep changing. And that's why I always have my feelers up, and I'm always looking for, what was that first attribute? The top dog and first mover in important emerging industries. They'll keep happening, but I'm not so much of a fad follower or trend spotter. I'm more just somebody who is willing to acknowledge that those are going to happen and we're going to get our money there as they start to emerge.
So what investors do you either most look up to, or maybe even earlier questions sort of were most influential in your style of investing?
Well, and I think I have about 3 minutes left, so I'll give a 1 minute or so answer. And if there's one more question of that, I'm happy to take it, but I also want to yield the floor at the appropriate time. I would say my favorite investor isn't an investor, but he's taught me more about investing and breaking the rules. And the things that I've shared with you this morning, I've been led to by just being a huge fan of Bill James, who revolutionized baseball by coming in from outside and suggesting a totally different approach that was so rule breakery in my parlance that he was shunned by the establishment for a couple of decades. He never played the game. He didn't know the power of bunting. He overrated walks. All these things. He was a journalist, and he was criticized. And these days, what he taught us all is not only conventional wisdom. It's used ubiquitously throughout baseball. And it looks so backwards now to look back 30 years ago when he first emerged. And I hope that that'll be true of rule breaker investing. And I hope that people will see that some of the things they took for granted, as the conventional wisdom has taught them, things like never buy a stock that has a PE above 25, things like that. I hope that we've started to learn that those are silly ways of backward thinking. And by overcoming that and thinking fresh, by taking a sort of data-driven approach without being a quant and being willing to think anew and differently and break the rules, that led to better thinking and better behavior among market investors, just like it has for baseball general managers today. I did spend 1 hour on a phone call some years ago, and we spent about half of that talking about autonomous driving. because Bill is fascinated by that topic. So anyway, there's my answer.
Well, thanks, David. I think we're right on time and right on schedule, and I appreciate you participating in the summit. And I think we learned quite a bit. So thank you again.
My pleasure. Keep up the great work, Ian. I hope everybody has a good morning, and I'm looking forward to more discussion in future. Full on.
Thank you.